And welcome into this week's Freightonomics. Zach Strickland here in studio. My co-host this week will be remote, Thomas Wasson, joining me. And there he is right there from his local abode. Thomas, this has been one of the weeks that I think took a lot of people off guard for I guess lack of a better way to explain it, but especially in the spot market, we had some pretty explosive activity. Did not appear to hit the truckload contract market or the broader market in total, but we had this Serbian news outlet reporting on these raids and the fact that they're getting targeted in some specific areas in these states, and it really shocked a lot of this what we would consider, I guess, transactional market capacity. The people that are not necessarily involved with like this long-term play with some of the larger shippers. A lot of times the brokers tend to contact this group of drivers, and it's kind of an early, I don't know if it's an early warning sign or if this is the start of something more major, but you did some back end digging on some of this stuff too. So I'm curious to get your take here in a little bit on what that meant. But overall, I think we're going to have Dr. Rogers on as well here in a little while. But this has been such a big story week. I think we got maritime stuff. We got upcoming peak season. We've got so much to kind of dig into and some stories that I think we have to note, but I think it makes a really good transition into Dr. Rogers. So I think we're going to progress with, hey, let's talk a little bit about this spot market activity into, and transition slowly into our economics and supply chain. What do you think about that?
Let's do it. Yeah, talk about compared to last month, or last 2 weeks ago when we last talked. This was not on my bingo list. The Serbian diaspora community talking about the impacts of ICE raids and recent crackdowns on folks who are driving without CDLs and their statuses. Definitely one of those things that we're seeing in the spot market. I personally believe it will be mostly isolated with the spot market, but one of the things you cannot discount is the fact that the spot market does drive the overall contracted space. So that's going to be one of those kind of conversations where we're going to see for freight brokers and shippers who heavily rely on brokers, this could be potentially a very big impact. For the rest of the contracted carriers, though, and you'll see it later, we're going to look at spot rates, tender rejection rates, kind of business as usual. These guys have been doing the right thing for decades. And so it's one of those things where the spot market is definitely kind of like cleaning house. It's almost like you go to your favorite restaurant and you find a bunch of cockroaches. It's a symptom of a larger problem.
Well, shoot, let's just dig right into it and do the marketing too and set the table with some data. I always love the data first approach, and then we can fill in some of the gaps anecdotally as we go. So you want to count me in from your,
Let's do it.
your bedroom there?
In 3, 2, 1.
All right. What better way? John Kingston always told me, FreightWaves reporter and historical oil market analyst from S&P Global, always told me, never bury the lead. The spot market rate here is the lead in the market. And two, look at that parabolic jump in the NTIL, which of course excludes fuel for purposes to compare to historically because fuel's volatile. Man, what a jump here. This is something we really haven't seen. Now, you can see in the very edge, if you look real closely, there is a little bit of a horizontal slant. So it jumped up real quick, and then it's kind of stalled out a little bit here in the last day. So maybe an early sign that this may be more like a road check week than something sustainable. Time will tell. Let's go to the map next and look at where spot rates are increasing the most. Here's something that actually really took me off guard in the way that this was not necessarily a regional thing. Like 2 days ago, the Midwest, right around Chicago, was dark blue, but most of the country was blue. That's an indication of increasing rates in the blue markets. The reds are the decreasing rates. And this heat map was mostly blue all over the country. So it wasn't just isolated to the Midwest, although the Midwest did seem to get it a little bit more aggressively. That has since calmed down a little bit here across the country, but again, we will see. Let's go to the next chart. NTIL versus OTRI. This is why it's very questionable on its sustainability. OTRI is there in the yellow. It has not moved. It does not care that we had this amount of capacity come offline. But of course, the OTRI measures more the contracted, larger carriers, larger shipper environment. This is not that group that is being targeted on the ICE raids necessarily as much. Let's go to the last chart. And this is another reason why I don't think there's sustainability here. Outbound tender volume index continues to drop and drop and drop. And we are now 20% lower year over year on the tender volume index. That is not a great sign economically. However, this is also a seasonal downturn here in the first couple of weeks of October. So that being said, Thomas Wasson, it's hard for me to, the biggest question I get right now, is this kind of the inflection point? Is this the turn? And it's just really hard for me to say that it is without other data points outside of spot rates telling me that it is. What do you think?
Exactly. I completely agree. We've got one indicator, spot market rates, but look at the demand side. I mean, you're really going to have to, and I said this earlier, 9 out of 10 truckload cycles are demand driven. If you have like the Motor Carrier Act of 1980 or something that the government does, that's kind of like the 1 out of 10, where we're seeing instances where capacity gets driven out of the market because of regulatory stuff. The issue is, like you said, it's just so early to tell. I mean, you pulled up that chart from looking at the 2 years worth of data on outbound tender volumes, and just looking at how low it is. It's so difficult. I think it's almost 2018, 2019 levels. It's a really hard case to make right now. That we're going to see something as like a sustainable upswing. Now, this may change if we continue to see it just straight going up in spot market rates. But it's right now. There's so much noise. We're still just kind of looking for that signal.
Yeah, let's put a bow on this and go into newsonomics, because Craig Fuller, our CEO and founder, wrote an article about the surprising surge in trucking spot market rates climb overnight. I think, for us, he calls me up when he starts hearing about this anecdotally the other day, and we're sitting there trying to sort through the data, and I think that's kind of like, it's great because we can lean on the data here. We were really kind of like, this seems like it may be a thing. There was a slight uptick in the NTI at that point. It was almost like it happened over the weekend, which is, there's not a lot of data out there that has that kind of responsiveness anyway. But the fact that we had something, but OTRI, we were sitting there for the last few days and we were waiting on OTRI to kind of show its signal, and it never came up. But this article that came out in the Serbian Times, and I think the question is this more of a road check week type thing? As they're doing these raids and it's getting headlines, and even this lawyer wrote this article. He's an immigration lawyer warning Serbian truck drivers to stay off the roads for fear of being detained or deported. Now, the question is, how sustainable is this practice, and how aggressive are they going to continue to be? Because they clearly can't be everywhere. A lot of these drivers have legal immigration status. They just spend part of their year here and they go back home after they make some money, because clearly the dollar value is still high enough to where it's worth a lot more over there. And, for not arguing the politics of the situation here, but that's kind of this segment where they can charge lower rates because of that reason, because their cost of living is lower in general. So that's what's inflating these rates, is they're losing some of these low cost providers, which the market has been bleeding for, the better part of the last 2 years, I think, looking at the data.
Exactly. It's you got to put on you remove your political hat, because right now people are obviously trying to get political brownie points
Yeah.
depending upon what team you're representing. But one of the things I think about in this is that it's just economics. It's arbitrage. If I have if I got $5, and if $5 buys me like 2 hamburgers in the U.S., but if I'm somewhere else and it buys me like 10 hamburgers, it's a pretty good deal. So that's one of the big things. And we saw Werner's CEO, Derek Leathers.
Yeah.
Was at a conference as well, talking about cabotage. And so, one of the things I want to remind folks is that while we have this immigration crackdown and going after drivers, I think one of the largest examples of drivers being placed out of service were CDL related, 2 out of 5 from last year's road check. Cabotage is another one. So, back in the past, and you know this as well, if you're a Canadian carrier, a Mexican carrier, and you're delivering into the U.S., you've got to take a load back. Like usually, you got to
Yeah.
find a load straight back. One of the things that Werner CEO talked about was there was some kind of data that said these guys were sticking out like 21 days. He said that basically, if you were just going down and back, that would not be really enough utilization to stay in business. And so it's fascinating because I think that there's kind of double dipping. And, I'm a big fan of Mexican food, but when you're mixing your queso and your salsa, sometimes you can disrupt the table. And what we're seeing right now is some of these carriers, it appears to be, they're going to be operating domestic intra US freight, which is clearly against the rules of cabotage. That they have set up. And so that's one of the very fascinating things. We've got some recent legislation proposed by somebody to change some of these rules. The American Trucking Associations has been focusing on cabotage a lot more than the non-domiciled CDL issue, and so I think it's kind of a wombo combo, so to speak, and that we're getting a lot more people paying attention to, what folks have been doing within the U.S. And so, based on the current rulemaking, it will be really interesting to see how this all turns out for sure.
Yeah, and of course, you and I are supposed to be doing a webinar next week that will dive more deeply into this Tuesday at 2 p.m. Eastern Daylight Time, while we still have daylight time. But I think, too, to keep in mind, this is probably one of the worst markets for a broker to deal with. I think we talked about carriers, but this is, like I said, this is a segment of the market that brokers really struggle with because they have a lot of contract rates that are set fairly low to just kind of keep business going. And then if they're covering on the spot market and rates jump quickly, it squeezes or just erases all of their margins. And they're underwater almost overnight when you have these sharp spikes after a prolonged downturn in the market. And I think that's one of the big questions is how to, if this is a sustainable thing, like brokerages are going to really have to be scrambling. For now, it looks like this may not be the most sustainable thing, but we're still fairly early in the process. So I want to transition slowly over to the supply chain side of the aisle here, and talk about how, we got an article that said the Costco will not be levying fees on or passing their fees along to the shippers. The charges, of course, for Chinese run and operated vessels that land at U.S. ports are supposed to get surcharges. And it's pretty steep. As much as $2.1 billion potentially that it could cost Costco and OOCL, which is their subsidiary or their owner. That's not that's a very, very high price tag that they're saying they're going to go ahead and just swallow in the near term. And of course, the maritime space itself is experiencing a growth of capacity, and it's keeping rates fairly low. But I think a lot of the shippers were worried about this fee, which clearly could have a pretty strong impact. But right now, it looks like that's not going to be passed along.
Yeah, it's a really interesting situation. Eating the
Mhm.
fees and everything is one of those things
Mhm.
that, in my opinion, it just goes to show that during these trade negotiations, the U.S. is just a huge
Mhm.
consumer market. We consume so much stuff, and it's really fascinating to see a situation where we levy these fees, and the ships are like, "Well, we still need you, so we're just gonna it's on the house. It's on the house. No worries." But also, there's like the what 5 or 7 large maritime kind of not cartels, but conglomerates or alliances. They got these various shipping alliances. So it's one of those things where if you do try to enforce these fees, is there the risk that these customers are going to use a different liner, a different ocean? Whatever the correct term is, it escapes me
Yeah.
right now. But it's a fascinating thing to see because we have all of these conversations about tariffs and trade. Some people are prognosticating that well, they'll just take their trade elsewhere. But it really goes to show at the end of the day that the U.S. is kind of like hungry hippos. We have the biggest button to push, and so we don't we still manufacture some stuff, but at the end of the day, we're going to find out the very limits of how much we can kind of haggle and negotiate based on our consumption patterns.
Yeah, and then Beijing even has stated that they may be subsidizing some of this fee as well, at least in the near term. Read that article for sure to get the full breakdown. They break down all the charges and everything that are going to get passed along. And then this next article, of course, peak season's upcoming. Peak season for trucking is typically around November, December, and it's retail centric. And, this article that Stuart Churls writes here by the quoting the National Retail Federation and some other analysts, expecting continued deterioration in the import market, well below average for the rest of 2025. Now, some of this is simply because of the pull forward activity. They feel like they are well stocked for holiday season. It, of course, happened in the summer because of the worries about tariffs. He breaks that down. But also, there's not a lot of expectation. If we look at the IOTI here, we can see this early pull forward wave that happened in June. So a lot of holiday freight coming in June, which traditionally that starts to actually come in late August for the holiday season, hops on a train or on a truck, moves across the country, gets in position by November, December. There you have your stuff in the brick and mortar stores and fulfillment centers. It's not a very seasonal pattern this year with that pull forward activity, and they're just not seeing a reason to think this year's going to be very robust from the import side. And that also is dependent on something we're going to talk to Dr. Rogers about here in a minute: how well stocked their inventories are and how confident are they in their demand forecasts. And this article basically states that their forecasts do not expect a very strong holiday season for the National Retail Federation. Analysts are expecting a growth of 3.7% compared to 5.7% in 2024. Morgan Stanley stated that. So cooling labor market, uncertain economy, like the same old kind of rhetoric that we've been talking about and hearing for a long time now. I just don't, is it a tired story at this point that we're expecting kind of a softer outlook? But yet, I think consumption has not been that bad from the retail side of things.
Yeah, consumption is chugging along. I
Yeah.
think the fascinating thing, we brought up that IOTI chart as well. There we've got the bump that was leading
Yeah.
up to it, July through August. We had the record amount. One of the big questions that I'm thinking about, because I remember having some conversations with folks. There was some, when you're thinking of your little Halloween and your Christmas stuff that you like to decorate outside, that stuff normally comes in like even up to a year in advance.
Hmm.
People are making these decisions really far ahead. And so there's a few strategies. One of the strategies was, do I order the same amount of stuff and just bite the bullet? Do I order less stuff and assume that prices will be better if I need to order at last minute? Or, is it one of those things where I just change my sourcing patterns entirely and have like a plan B and a plan C? And so, one of the questions I've been trying to find the answer to is that, are we going to see this kind of behavior? What happens to the people who waited? Because right
Yeah.
now, we saw, we'll have Dr. Z talking about one of the big things, upstream and downstream and inventory levels. So the people who've already stockpiled their stuff, well, you're in a much better spot. You're going to slowly distribute it down as items get bought. But with these coming possible capacity crunches, and it's still, I call it the fog of war. We're in the fog of war right now. We don't really know yet. We need a few more weeks to see how this peters out, leading into peak season, to see if it's sub seasonal or out of abnormal kind of behavior. But what happens to the folks who just kind of wait and see approach? Because if these shippers and these customers did not bring their goods in early through most of the year because of the tariff jitters and everything, what is their behavior going to be? Is capacity going to be abundant, whether it's maritime or truckload, and kind of how's that going to play out? And so it's kind of like that kid who didn't do their homework. The test is coming up, so we'll definitely have a form of crunch time for sure. I think we do at least need another month to see how this is going to happen, because if we start to see a continued move and a continued uptick in spot market rates, that will put pressure on third-party logistics providers. Think of it like The Big Short. You're suddenly underwater instead of being underwater on your mortgage, where the value of your home has fallen so far and that you're paying too much. Are you having that on the lanes? And so
Yeah.
it's very, very early to tell. But if we do continue to see that movement in the spot market, we should start to see tender rejection rates and other things move up. Because if I'm a large carrier who's mostly exposed to the contract space, I'm going to start declining it because I know I can get a better deal. But right now, just really too early to tell.
Yeah, agreed on that. So let's bring on the man, the myth, the legend, Dr. Rogers. He's been waiting patiently. Don't worry, Dr. Z. We still have 25 full minutes to fill up here. So, normally I like to get to you as soon as possible just so we can get it all in. But you've got a full show left. Now is the Dr. Z 30 minutes that we get to run through. And I was reading through the LMI report today, actually, and the numbers that stick out to me the most were in the warehousing side of things, and that directional shift there. It's kind of what I want to lead off with, is the warehousing side, where we see prices coming down and utilization going up. Which, correct me if I'm wrong, but this feels a little counterintuitive.
Well, the one thing to remember is that any number over 50 still does mean expansion, right?
Sure.
And so really what
Fair.
we're seeing is that warehousing prices are growing, but more slowly than they have been, and utilization is going up. But when you break that down into like our upstream and downstream splits, I actually do think it makes a bit more sense. We've seen a real shift of inventories downstream in the last month and a half. I mean, we started to see it really in the second half of August, which makes sense because you usually see inventory go to the retail level around now and then sort of peak in October. And so one of the things I think that we're seeing is we had so much jammed in at the wholesale level for really the last 6 months. And as that starts to trickle down, what we're seeing is more utilization of warehousing overall, right? So there's more space now that we're putting stuff in. It's less concentrated. It's more sort of decentralized. And because of that, the really sticky, hard prices that we were dealing with upstream, because you think about this, a lot of wholesalers were doing like short-term leases. I mean, you think about a warehousing contract, maybe it's going to be a year to 3 years normally. But for the wholesale level, because we brought so much stuff in so early, they were kind of going on like the warehousing spot market, basically, to get all of this extra space that they needed early on this year. Well, that's expensive. It's usually a minimum of 3 months, and to get 3 months, you're paying probably some sort of premium. And so, what my read is on this is that 3 month short-term lease warehousing, I mean, it's like going month to month on an apartment. It's really inefficient. They kind of had to do that upstream, and now that we're having this sort of spreading out of all the inventory that's been here, it's making utilization go up because now the downstream folks are utilizing more of their warehousing space. But it's also making price growth go down upstream because now we're getting out of some of those short-term warehousing leases that we were sort of a necessary evil that we had to deal with through the summer as we were trying to avoid tariffs.
Nice.
That was a lot.
Yeah, I mean,
especially with the pricing.
but I love.
I've been sitting here for 18 minutes, just I've had, it's a lot of potential energy transferring to kinetic.
Well, I didn't think of the short term. That's what blows my mind. Like
Yeah.
you can just get a warehouse for three months. These short term leases. That's a very interesting play, especially when we're thinking of the broader inventory trends. That's what I was curious about. One of our conversations was: are we seeing the upstream movement back to the downstream? Is this going to help trucking capacity? Kind of how does that warehousing play go into the overall broader inventory trends? Because a lot of these transportation providers, I'm almost just waiting to see if, from up high, from this distribution to outbound stores.
Well, our downstream folks are pulling more inventory down. We saw all the way through the summer that inventory levels downstream, so the retailers, were negative. So they were reducing inventory all through the summer because they had built up such a huge stock of it. I mean, we started really having big imports in like the late, part of December, which is not normal. And it came through all the way, through March. And we had the big spikes in July and August. And so we've seen retailers start to pull inventory down. We saw it start in the middle of August, really continue in September, and I'd expect it to go at least through October. And it could actually even be longer this year because there is a lot of available transportation capacity. So we could see the peak sort of extended, I think. So it'll be a little bit more flat. Now, if you look at our inventory levels and we split upstream and downstream, upstream's at 55, downstream's at 54. So it's not a big wave transferring downstream. If we look at things like transportation, right? We had sort of an interesting situation this month, and it started in August, where we're actually at a slightly negative freight inversion. So if you look at where our transportation capacity and transportation prices, anytime capacity is growing faster, there you go, is growing faster than price, I tend to think that sort of represents supply outstripping demand a bit. Okay, you can kind of think of that white line there. Capacity is supply, and the yellow line is which is price is demand. And so, as we know from our freshman level econ class, when supply goes faster than demand, price is going to come down. It's a soft market. This is the second month in a row, by the way, that we've seen capacity above price. Now, it's only about a point above price. I think it's actually 0.9 points above price. So it's very marginal. Really, they're about the same. But if you split that out, Thomas, and this goes back to your question, into upstream and downstream, okay? Downstream, it's a little more serious. Upstream is a little more serious. Downstream is pretty busy. Upstream, transportation prices are 51.4. So basically, we're at break even levels, on the verge of going to contraction. Their transportation capacity is at 56.5. Okay. So we have a 5 points. You can think of that as like a negative 5 point inversion upstream at the wholesale level, where we've been holding on to all this stuff. Downstream, capacity is only at 52. Prices are at 61. So a full 10 points higher for price growth downstream versus upstream. And really what that shows us is that it's the consumer, it's the retailers that are pulling the truck market out of a recession, I think. We've got 2 months in a row of a negative freight inversion. Again, it's tiny. It's tiny. Mm-hmm. Every time we've ever had 3 months in a row, by the way, that's only happened twice, where we've had 3 months in a row of sort of this flip where we suddenly go from price was higher to now capacity is higher. Anytime capacity has been higher for 3 months in a row, here's the 2 times that have happened. 2019, 2022. What happened those years? We had freight recessions.
Right.
Now, that's not to say that if we have a downturn next month, that'll happen. And actually, I would point out that in September, the second half of the month, because of this downstream activity, we actually had a positive inversion in the second half of September. So I would anticipate that this is going to look like 2018. Because what happened in 2018 is that was the first time we had tariffs, which in retrospect were just adorable little tariffs. I mean,
nothing. Yeah.
The 2018 tariffs. And so what happened is we did see a slowdown B2B. All right, we saw the upstream slowdown in 2018. Remember, FedEx missed their earnings a couple times, but the consumer stayed strong, and it stayed strong all the way through the holiday season, because no matter what the tariffs are, it's still going to be Christmas on December 25th. Okay, that's still coming. And so the consumer basically pulled us out of the fire, and we stayed positive. Even though we had real weakness B2B all the way through the second half of 2018, we didn't see a real inversion until April of 2019. Okay, we saw the consumer basically pulling the freight market along all the way through the last few months of 2018, and then the sort of normal restocking at the beginning of 2019. It wasn't until we got to spring that we saw the inversion. And then when we did invert, we inverted hard, much harder than we're inverting right now. And so in terms of whatever that question was you asked a while ago, no, in terms of the upstream downstream thing, to me right now it looks like basically all the upstream activity, or the bulk of it that we were going to see this year, happened. It happened a few months ago. Now it's the downstream activity that's happening. And that's what's sort of keeping us from going really negative in the freight market. That being said, it's hard to know how long consumers will be able to keep us out of this. Last time, 2018, which again is very similar dynamics to what we're seeing now, they pulled us out until April, and then eventually we did dip. I don't know that that will be the case. Partly, it depends on policy issues. If we see some stabilization, and we don't have rules changing every day, we might be able to see, hopefully not a dip in April. I'm not sure, and I'm not saying there would be a dip in April, but right now it does seem like all of the activity is, especially in the freight market, is at the retail level.
Yeah, I mean, this is the retail time of year. 'Tis the season that we get ready for the holidays. Now, we just had Prime Day-ish to Prime Days in October, and you obviously have experience from your Amazon days. Have we heard any early reads on that? On what I mean, because that has tended to kind of stabilize peak season a little bit over the past several years, where we have this more of an elongation in peak. It's kind of like they know that October is a slowish month, especially in transportation. Consumption tends to slow down a tad. Are we seeing or hearing anything on that yet? Do you think it had a meaningful impact?
I didn't look at their prime numbers this morning. Like you said, I've spent so much time in the trenches with Prime. I don't.
Yeah.
But what I will tell you, speaking of seasonality, is that I actually thought the most interesting number in the report this month was transportation utilization, which is not a number that we talk about all the time. But it was really different, I thought, this year, because actually it was every metric we had other than one was in expansion this month. The one that wasn't expanding was transportation utilization. It was flat. It was right at 50. And, so what that tells you is, all right, there's no movement. Okay, fine. In a vacuum, you might not think that's a big deal, but contextually, September should be a big month for transportation utilization. We should see utilization going up because we're in the peak, right? But we didn't see that. Our normal, I looked over the 8 years before this one, our average reading for transportation utilization in September was 65.1. Okay, so 65.1 is a pretty robust rate of expansion.
Wow.
We're at 50 this month. And so what that tells me is that we're not seeing the freight market crest the way we normally would expect. And I think it's partly because we've got, like we've said a couple times, the bifurcated peak season. Upstream happened. Now we're in downstream, and downstream can't soak up all of the capacity that's available. And so utilization hasn't really changed at all. And I think it's really interesting. If you think about September, we should be getting to the high water mark somewhere for peak. And if this is the high water mark, that doesn't bode particularly well, I think, for when we turn the calendar into 2026 and might expect some seasonal sort of slowdown. So if this is our high point, I'm worried about our low points a little bit.
Yeah, that was one of the challenges. Looking at outbound tender rejection rates as well, talking about that upstream and downstream, we almost see kind of downstream is where spot market really likes. Upstream, you're thinking larger customers, kind of DC transfers. So it's interesting to see. You talked about the transportation metrics, kind of how we have this situation where in our high frequency data, it kind of looks similar. We're asking ourselves, why is it that we're seeing more activity in the downstream spot market with recent moves, but at the same time, there's just not enough going up in the larger ones, even from a utilization standpoint, like a 5%. And I'll get Zach's thoughts on this as well. 5% is usually in the money. If a lot of these tender compliance rates, when you make a deal with somebody, they'll want you to have 95% or better tender compliance. And so I think it's very fascinating. It doesn't really doesn't look too good for the transportation side going into Christmas, though. Unless we take a lot of capacity out of the market, like you said, utilization, that's going to look really poorly. If you're having it a flat 50 in utilization when you're normally in the 60 to 65 range, that's kind of troublesome, because if you're a trucking company, you have 18 wheels, mobile factory on 18 wheels, and your output is revenue miles. And so if utilization's not going up, it's almost like your little factories aren't putting out enough.
No, that's absolutely right. And it's one of the reasons actually I don't think the language checks and all that stuff. I don't think that's going to be a huge deal. I actually think that we have capacity to spare right now. Um, and I also think it's going to be smaller. I mean, this reminds me. Remember a couple years ago when you guys kept writing articles about we were going to start paying student loans, and it was going to crash the economy. This reminds me of that. This doesn't seem this doesn't seem like that big of a deal. But I will say that the capacity piece does matter, and the almost, to me, Thomas, the more interesting split in terms of where we're seeing things even more than upstream and downstream is our large and small respondents. We've been talking all year when I've come on the show about how the smaller respondents have really sort of carried the cost of tariffs all through the year, because the smaller respondents, you got to think they don't have a ton of cash on hand. And so you sort of had the devil, which is storage costs of extra inventory, or the devil you don't know, which is what are these tariffs going to be. Smaller respondents, much more than our larger ones, went with the devil they know. Okay. The larger ones were willing to dance a little bit, but the smaller ones went with the devil they know. And so if we look at inventories right now for our small respondents, it's at 61.7. Our large ones are at 48. That tells you that the large ones, who are more retailers, but not all retailers, are still having their smaller partners basically hold on to inventories. And we know they're holding it because when we look at transportation capacity, like we were just talking about, for the smaller respondents, capacity is 58.7. That's the highest transportation capacity number we've seen in 2 years, probably since probably early 2024, maybe like January 24. Down for the large firms, it's 50.9. So the large firms, even though they're keeping inventories very low, are utilizing all their transportation capacity. We also see they're at 57.5 for price, and the small folks are at 50.9 for price. So basically, the small firms have a huge level of inventory and no movement. I mean, 50.9 for price means basically no movement in their transportation. And so a lot of times you have, these sort of small ecosystems of carriers and shippers, and that sort of exist, and sort of a closed loop a little bit. And so what that means is that probably some of our smaller carriers as well, or the carriers that specifically work with some of these smaller respondents, and that could be maybe they're wholesalers and it's certain upstream lanes. It could be different sort of regional things. They're probably feeling this same crunch. And we saw last week ADP put out jobs numbers. We didn't get a BLS report because no one's at the BLS today. I was at a conference in Washington D.C. all weekend, and I was thinking I might be the only person here who's doing any work right now. And so when the ADP thing came out, we saw that we were 32,000 jobs down, but 40,000 jobs down if you look at employers who have 50 employees or less. So what that means is some of our larger, ADP's large respondents added jobs. A lot of that would be seasonal sort of retail stuff. But the small firms were hemorrhaging them. And I think that is probably related. All year we've been saying costs are so much higher. The inventory load is so much higher for our smaller respondents. And now we're in September and it's still at a 61.7. It may not be moving quite as fast, and they just can't keep bearing all these costs. And I think I'm not surprised, honestly, that we're seeing the cracks form in the smaller businesses first, because in our numbers, we've seen those smaller respondents carrying such a big load in terms of inventories and the associated costs really since like April.
So, I mean, the government has been a big factor this year, clearly, in a lot of things. And I do get some decent questions around how's the government shutdown play into all of this. I'd love to get your take to see how you think. I mean, you just spent the weekend in Washington D.C. What's the scuttlebutt, man? Like, what are we dealing with on the economic side as the government continues to be in furlough mode?
Well, I will say most of the restaurants are still pretty overpriced, so that hasn't changed. I would say that there's some slowness sort of in the city, I mean, to me, what's hard is the loss of the government data more so than anything in the very short term, right? Like the fact that we don't have the jobs reports, the fact that we're missing some of these things. I'd really love to see what's going on with inflation and certain things. I think is tough in the short term. Now, long term, where let's say this goes for a month, and I hope it doesn't go for a month. But let's say it goes for a month or 2 months, we start seeing real cuts to things like, food stamps and health programs and all this stuff. Well, we saw during 2022 that when food and gas and the essentials of life get much more expensive, which if, food stamp programs go away, they would, right? That we don't spend on durable goods. We spend on the things we need to stay alive. In 2022, that was gas and food. And so if we don't see these things come on and we don't see those programs continue, I would anticipate we could see some drop in overall consumer demand. I mean, right now, the retailers are pulling all this inventory down because we are depending on the Superman of the economy, of the global economy, which is American consumers, to come through and pull everything out. If costs go way up for certain components of the American consumer base because of loss of programs or whatever it is, and also, by the way, 750,000 people are furloughed right now, and for each government job, especially if it's like a sort of manufacturing, like a government job, like let's say in defense or something like that, you got 10 other jobs supporting those, right? So if we see orders slow down anywhere, it starts to hit suppliers. So to me, what I would worry about if this goes on too long is that we see a softer than expected holiday season, which would be devastating for those small businesses, especially who still have all this high inventory. Because then think about that. We brought all this inventory in like April, paid these high costs for 6 months so that we could sell it in the holiday season, and then the holiday season ends up soft. We could have a real problem, and we could actually see a bit of a bullwhip effect like we did in the spring of 22, where we have too much inventory on hand. So to me, it would be nice if everyone could just calm down. we could we could turn the government back on and make sure that we have a nice holiday season. I can't imagine that it's in anyone's best interest to not have that happen.
Largely negative on the outlook there, in terms of if the government continues to shut down. So we've got about 2.5 minutes left. What are people saying about the future? Or have things changed on their prognostications significantly? What's the most interesting take here?
I think the most interesting part to me is that when you put it all together, it looks like people have sort of settled on, well, we're going to have some tariffs
Yeah.
and it's going to make costs higher, but hopefully we'll know what the tariffs are. And if we know what the tariffs are, we can get better utilization. And so here's what I kind of mean by that. This year has been start, stop, start, stop, start, stop. And so we've seen, okay, we need a ton of capacity in July and then not very much in September. And it's very uneven. Our future responses basically say, so inventory is at 55.7. That's just above replacement, right? That's JIT plus. So we're sort of bringing in inventories at a very steady rate. Inventory cost at 69.9, so about 70. So what that tells you is, look, we're bringing in a sort of steady rate of inventories, but we're going to be paying a lot, maybe because of tariffs. But at the same time, look at warehousing, 49.5 on capacity. That's great utilization. 67.9 on prices. That's not the crazy out of the box mid 70s, high 70s prices we had earlier this year. So that tells you we might not be having all those emergency 3-month leases. That's what sort of killed our prices earlier this year. Transportation 51.4, good utilization, and price at 66.7. And so when you put all that together, basically what that tells me, guys, is that we're going to be pulling inventory in, but we'll know when it's coming in. So we won't have these emergencies. It won't keep being an emergency. We are going to pay more for that inventory because it seems like people are not crazy optimistic that all the tariffs will just go away. But because we know when things are coming in, we can have sort of steady utilization of warehousing and transportation in sort of that JIT manner that will be a little more stable.
Right.
So again, to me, this shows supply chain resilience, and we got a lot of smart people who are figuring things out.
Oh, man. Well, thank you for that hot take, Dr. Rogers. We'll see you in a month, hopefully. We might have a Supreme Court ruling at that point as well.
Well,
maybe.
I mean, what more exciting words could there be than we?
Well, I mean, we'll all be waiting. Have a great week.